Do you want to know the secret behind the most successful investors and traders in the world? The answer is simple. They avoid using technical analysis. Technical analysis is stupid and should be avoided at all costs. In this video, I will be detailing why I believe using technical analysis is a horrible idea and why you should avoid it at all costs. Just a quick disclaimer before we begin, I do believe that in some cases technical analysis can be useful. However, I am strongly opposed to how technical analysis is used currently. It is marketed to perfectly predict the stock market, and that's just not true. Most people that learn technical analysis don't know enough about investing and use technical analysis as the only way to invest in stocks. Technical analysis should only be accounted for a small part of the decision to buy or sell a particular stock or crypto and not the only way. First, let's define what technical analysis is. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity such as past prices and volume. The idea behind technical analysis is that by studying charts and patterns, investors can gain insight into future market movements and make more informed investment decisions. Now you may be thinking, that sounds like a pretty good idea. Why would anyone avoid using technical analysis? One of the main criticisms of technical analysis is that it lacks a fundamental basis. Instead of analyzing a company's financials or the overall state of the economy, technical analysis is based on patterns and trends that may or may not have real underlying meaning. This means that technical analysis is essentially just a form of guesswork, with no real scientific basis to support its claims. Furthermore, technical analysis is based on the assumption that the past market movements can be used to predict future movements, but this is just not the case. Markets are complex systems and are influenced by various factors, including economic conditions, political events, and even human emotions. It is impossible to predict how these factors will interact with each other and influence market movements. Additionally, technical analysis relies heavily on past prices and volume data, which may not be a reliable indicator of future performance. Markets are constantly changing, and what worked in the past may not work in the future. This makes technical analysis a highly unreliable method of predicting market movements. Another major problem with technical analysis is that it can be self-fulfilling. This means that if enough people believe in a particular chart pattern, they may act in a way that causes the pattern to become true. This creates a feedback loop where the market moves in the way that the technical analysts predicted simply because they predicted it. Moreover, technical analysis does not apply to all markets. It may be less effective in markets with low liquidity or less developed markets. Therefore, even if technical analysis worked in one market, it might not be applicable in other markets. But that's not all. There are also cases where technical analysis has failed spectacularly, some of the most notable examples being the dot-com bubble, where many investors were using technical analysis to justify buying overvalued technology stocks, and the 2008 financial crisis, where technical analysis failed to predict the collapse of the housing market. In conclusion, technical analysis is a fundamentally flawed method of evaluating securities. It lacks a real economic basis, can be self-fulfilling, and is based on the idea of a random walk, which suggests that past market movements can be used to predict future movements. Additionally, it relies heavily on past data, which may not be a reliable indicator of future performance, not applicable to all markets, and has failed spectacularly in the past. While I do understand that hedge funds and large banks use technical analysis in their calculations for stock trading, they also use a bunch of complex formulas and systems that the public does not have access to. This gives them much more perspectives as to whether or not a certain stock will go up or down. As investors and traders, it is important to remember that there is no surefire way to predict market movements. However, by avoiding methods like technical analysis that have been proven to be ineffective, we can make more informed and rational investment decisions. Rational thinking can not only work in the stock market, but also in the new emerging financial section of cryptocurrency. If you want to find out how to invest in markets such as the crypto market, make sure to watch the videos linked on the screen now. Peace out.